Good afternoon and welcome to everybody. Welcome to this week's Elite Traders Club education session. This week, talking about quantifying a trading mistake, and this follows on from the previous couple of education sessions where we've actually discussed what are pretty common trading mistakes. And what I did for the basis of those two webinars was to really reflect on some of the writings of Kel Butcher in association with some of his trading colleagues over many years of experience, where he went through and interviewed them and found out what were common mistakes amongst many of their friends, their clients, peers along the way. So that sort of forms the basis or the background of this particular session. Interestingly, at the recent academy, some of the sessions we talked about, we spent a fair bit of time talking about trading psychology and what a significant part of your actual investing, of your trading, psychology plays. So much so that a well-known trading psychologist, a chap by the name of Van Tharp, who's written many, many books, many years ago, really sort of came to the conclusion or the assumption that psychology was around about 70% of the important part of trading. 70% of it was really due to your mental state, how well you control your emotions and how well you're able to, on the basis of that, follow a trading plan. In more recent times, he's changed that figure and actually said that 100% of trading requires psychology, a strong, stable, emotional state, and that no matter what your methodology or your money management, sure, that will help, but if you aren't of the sound mind, if you like, in a trading sense, then you're going to find things very difficult. So on the basis of that, I thought it was probably time that we spent a little bit of time talking about common trading mistakes that people often make in their own do-it-yourself style, but also, I guess, some of the mistakes that perhaps clients on the Elite Traders Club find themselves falling into. So let's get underway. Enough of the preamble. And again, as per usual, just our disclaimer, the content of today's presentation or any other ETC material doesn't constitute a recommendation, nor does it take into account your investment objectives, your financial situation, or particular needs. Before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, so common trading mistakes. So sitting on this side of the fence and coaching people along the way, and basically observing some of the mistakes that people make, there are many common ones that come to the fore. One of the main ones is fear of loss, particularly when the markets have been very difficult to trade. There's a distinct temptation to take any profit that presents itself, and that raises a number of problems. First of all, you end up risking more than what you initially started to try and achieve, and that throws your whole expectancy risk-reward equation out the window. And if you keep doing that, it's very difficult to stop, and it's certainly going to do your account no favours at all, because you're in effect risking much more than what you stand to win. So that really means that you need an extremely high strike rate, and a lot of people don't realise that. One of the other mistakes that clients make due to whether it's a lack of discipline, certainly lack of patience, is not allowing trades to evolve. Now, your best trades are going to take time. They don't occur overnight, unfortunately. And I guess it's an individual characteristic that makes people want to take any profits that they have, or they become impatient. And as a result, quite often exit trades without actually having a trade signal to do so, i.e. they're shortcutting their trading plan. And again, that presents a number of problems as well. And what they're unknowingly doing is potentially devoiding themselves of those trades that can make a significant difference, not just in the short term, but absolutely over a longer term time frame. And that's what we're trying to achieve, is to become consistent traders over the longer term time frame. A lack of discipline, if you've never had discipline in your life before, then you're always going to find trading and investing very challenging. If you're impulsive, if you have a typical Australian attribute that you like to have a bit of a punt, a bit of a gamble, then you're going to find trading difficult as well. Trading is certainly very different from punting. There are even professional gamblers out there who are completely the opposite of your normal gambler. The normal punter will just go down to the racetrack and pick any number out of the hat, or the colour of that the jockey's wearing, or the colour of the horse, or whatever it may be. Whereas actually professional punters have a system, they have a methodology that they're steadfast in sticking to as well. If you've ever been inconsistent before, then any of these frailties that you have as an individual are certainly going to come to the surface when you're trading. And being in a hurry, a lack of patience is certainly one that perhaps the younger generation would perhaps be perhaps a little bit more guilty of than some more senior, mature members of society. But still, again, if you're an impatient person, then you're going to find trading and investing difficult. A common theme that I hear when speaking with clients is asking them why they got out of a particular stock. I quite often hear, "I just thought." And as soon as I hear those three words, I know exactly that they haven't followed their trading plan. I just thought it had gone too far. I just thought it was time for a pullback. I just thought I'd take some money out here. I just thought the market was looking like it was going to go the other way. I just thought whatever it was. So really, whatever excuse it is, people interfering with their trades and therefore not allowing them to evolve. So from that point of view, these are just some of the common trading mistakes that are all pretty natural in the development of a trader. I know with speaking with a number of clients that they would certainly acknowledge that these were impediments to their early success, and it was only through getting to know themselves a little bit better and being a little bit more honest and really thinking about what their job was, and that is to follow their trading plan, that they too would have gone through some of these learning experiences. What I want to go through today is, what do these mistakes cost? So in terms of that, I want everyone to think about the way that we measure our risk on a trade. So when we're thinking about a risk per trade, remembering that we need to fix the amount that we're risking on every trade, so each and every trade shares exactly the same level of risk. Again, dealing with clients who have all different size capital amounts, it still amazes me that some clients will use a fixed dollar amount. Well, a fixed dollar amount's very easy to do. For example, they might have $100,000 and they just say, well, look, I'll spend $10,000 on each stock that I have, but that doesn't take into consideration the volatility of any of those stocks and how much one might move versus the other. So we always try and, when we're doing our position sizing, make sure that we've got the same amount of risk. That is, that if we pick the trade and the trade goes the wrong way, that the loss experienced on each and every trade is exactly the same. So the way we do that is allocate a percentage of our total capital to each particular trade in terms of risk. We convert that percentage, as I'm sure most of you will know, into a dollar amount, and therefore on that dollar amount we can position size accordingly. So basically the difference between our entry level and our stop level is the risk in cents, if you like, or dollars and cents, and we just divide that into the total amount of capital we want to risk on that particular trade, and that gives us our position sizing. So whatever that amount is, we call that R. And the reason for going through this today is I want to talk about the cost of a trading mistake measured in R multiples, what it might actually mean, and whether or not you've ever thought about a mistake in those terms. So some of the things we need to be thinking about when we are entering our trade and our trade has been triggered. Our job is to be attentive and allow the seed, if you like, that capital seed, to germinate, to grow, and to prosper over a period of time. Now, it's going to be exposed to all different weather conditions or market conditions, call it what you like, but your job is just to monitor it. Don't overwater it. Don't prune it before it's had the opportunity to grow. But also, very importantly, like when you plant a tree, read the care instructions, i.e. read your trading plan. What is it that you need to do to allow that seed, that new seedling that you've just planted, to grow? You need to be patient. It's going to take time to establish. Now, once you're first in the trade, the first thing that we're looking for that trade to do, if you like, is to grow some roots, i.e. that it's starting to move in the right direction. You'll know when that starts to occur because our trailing 3 ATR line starts to come up and pass our initial 2 ATR based stop. So that's the first sign that it's starting to move in the right direction. Some trades take longer than others. Some trades may not even get to that point. You may well be triggered in and the trade turns around and goes completely the opposite direction and stops you out. That's just part and parcel of being in the markets. Your job is not to try and preempt that or try and think, well, look, this is going in the wrong direction. I'll get out now before it hits my stop loss, because you may well find that the trade turns around and continues upwards in the right direction, and you've destroyed a perfectly good seedling, a perfectly good plant, and you'll never know what it was going to turn into. So sometimes, as an example, there's a plant in China, I think it's Chinese bamboo, which literally takes around about 12 months for the plant to grow. The first time you put it in the ground, it doesn't do anything for 12 months. And all the while it's in the ground, it's establishing roots. And then no sooner does it start to sprout, and then it becomes one of the fastest growing plants in the world. So sometimes things can take a little while to get going. So obviously throughout the course of your trade, what you need to be doing is keeping a record of the movement of the stock. So you've got your trade journal, you're seeing where its current value is, and only at the right time, once it's established itself, once it's strong, is it time for you to consider taking some profits. Now, as far as our trading plan goes, we've got some metrics along the way that suggest to us when the stock might be ripe to take some profits, and one of those is certainly the price volume volatility signal. Remembering that if that signal happens to go off and you are sufficiently up in your trade, now sufficiently up in your trade means at least a minimum of 1-to-1. Okay, so you're not taking any profits before 1-to-1, and ideally around the 2-to-1 type of level. So on average, most of our trades have around about a 10% stop loss, give or take. So should you find yourself in a situation where you're up somewhere around 20% in a fairly reasonable space of time and the price volume volatility signal goes off, then certainly that's an opportunity to perhaps trim the tree, give it a little bit of a prune, put some profits in the bank, and that does two things. First of all, it makes your account grow a little bit. It makes you, the curator of the trade, feel a little bit better about what's going on in with respect to the way that you're managing the trade. Because the other thing is that should that tree or that trade continue to move in the right direction, if it's tree, it's going to grow upwards, and if it's going to be moving upwards, then there's always the opportunity to add back into the position. So don't be afraid of that along the way. Over a period of time, as you're recording its growth, observe what sort of a tree have you managed to actually grow. Is it growing in the right direction? I know a few of you recently have been in stocks like Capilano Honey and Blackmores as an example. Auckland's airport is another one of recent times that continues to move in the right direction. Plus a range of other stocks as well that are at this point up around about 10 or 15% in the watch list. So your job is to continue to monitor and obviously not interfere too much. What I wanted to do now is to go through and have a bit of a look at two examples of Trader A and Trader B. So let's go, what we might do here is go through and have a look at a chart. Now this is an example of a setup recently, or a couple of years ago in actual fact, where back in 2012, and it's Ramsay Healthcare, which we've seen a lot of, but it does provide a really good example because there were so many opportunities to participate, not just in a stock moving like this, but this actual stock in itself presented a lot of opportunities. There was a trade set up back in towards the end of 2012, and many opportunities even before then where you could get into this particular stock. And typical type of situation where we get a really nice clean setup with really good price action, as you can see through here, and a tale of two traders where one trader happened to get in this particular stock at around about the $27 level, $27.22 to be exact, and got in at that particular price and got out at $30. Had only been in the stock for a period of time and saw the price go up to $30 and then start to go sideways a bit and move back down. And trader A said to themselves, well, look, it's gone from $27 to $30. It's going sideways. I'm going to take all that trade off the table, and they exited the trade completely. They felt pretty good because the risk that they had on the trade was a little over $2, and they'd made around about $2.80 on the trade up to $30, and thought, well, that was a good exercise. That was a good trade. During the end part of 2012 in itself was a pretty good year. 2013 in the markets was pretty terrible. Very difficult to get any stocks that really trended in a very strong way. So trader A left the market after cashing in at around about $30. The reason they got out, well, a number of reasons. Typically, they start with the three words, I just thought that it was going to struggle to get past $30. I just thought I'd take the money off here because you can't go broke taking a profit. I just thought Ramsay had such a good run that it couldn't possibly go any higher. I just thought it was due for a pullback. Whatever the reason was, it had nothing to do with them following their trading plan. They were self-sabotaging. So that in itself is a mistake. We didn't stick with the rules. Trader B, however, knew that their only rule to exit was once price closed below a trailing stop. So Trader B was actually able to, in risking exactly the same amount, that is $2.11, was able to ride the trade from $27.22 all the way up until price finally closed below and exiting at $60.57. So that's a significant difference. So that seed, if you like, that $2.10, $2.11 seed, by simply following the rules, grew to $33.57 in terms of growth. That's the change in the size of the seed, if you like, from $2.10 all the way, the initial seed growing to a value of $33.57. So a little bit like Jack and the Beanstalk. Didn't cut down the beanstalk until eventually it stopped growing. So that in itself represents a return of 16R. So 16 times the initial risk is what we were able to get out of that particular trade. Trader A, however, only got a return of around about 1.5R. So it's a massive difference. One return simply through following the rules, not making any mistakes. The first trader making the mistake, getting out at $30 purely because they thought something was going to happen. So the impact of that particular mistake was a cost, if you like. Instead of getting 16R, they got 1.5R. So that cost them around about 14.5R through one simple mistake. Very, very simple mistake, easy to make. So if we go through and have a little bit of a look at what that means. So trader A entering at 27.20, making a profit of around $2. Sorry, the initial risk of $2.10, getting out at $30. Couldn't possibly go any further. You can't go break taking a profit. How many times do you hear that? You absolutely can go broke taking a profit. Made a profit of just under 1.5 R. Trader B, entry, same level of entry, different exit, exactly the same risk, but the profit there significantly different. And the reason for the exit, I just followed the rules. So there's a massive impact of not following the rules. That's just one example. Now, certainly, it's a fairly extreme example in that Ramsay had been a stock that had performed very, very well for an extended period of time. But there will be lots of other opportunities where, for some reason or another, we will make the excuse to get out of something for any reason not to do with our trading plan. In other words, we are sabotaging the growth, if you like, the germination of the seed, allowing it to grow to become, something much more significant. It's not going to happen to every trade. Sometimes your trades are going to turn around no sooner as you get triggered, go exactly the wrong way. You need to follow your rules there in exactly the same way and get out according to your trading plan. Conversely, a number of members will be in a trade that has triggered its protective stop and should have been out of many weeks ago. Why didn't you get out? I just thought I'd give it a little bit more room. I just thought it might come back. I just thought the market was going to follow through the following day and bring it back up. For whatever the reason, it is normally the excuse is I just thought. Okay, that's why we have a business plan, a trading plan. The impact here, the cost of this mistake, trader A, they missed out on 14.6 R because they made excuses as to why they should get out. So that simple mistake over the time frame of around about 18 months cost 14.6 R. Even though they still made a profit on the trade, how aware are they that the fact that that mistake cost them 14.6 R? Trader B, perhaps they didn't know any better. Perhaps they just knew the right thing to do was to stick to their rules. And as a result, profited 16 R by not making a mistake, by not doing anything fancy, just following their rules. So there's a massive difference between following your rules and not making any mistakes, and thinking that you're following your rules but making all sorts of mistakes. So the task here for everyone is to think seriously about all the trades that you've been in over the last 12 months, 18 months, 2 years, however long you've been in the markets, where you've been consciously aware of the level of risk you're taking on a trade. So think about that in terms of the initial R, the initial risk on the trade. Go over every single trade. Have a look where you entered and where you exited. Did you follow your rules? Now, certainly some of the rules that we've got with our trading, we've changed over the last 6 months in particular to allow stocks to have more room, to give them the better opportunity for trades to evolve. Certainly strangling your trades is not going to help trades evolve. You're certainly going to be stopped out more often than not. So write down what mistakes you've actually made in the past, articulate them, write them down, and commit to change to make sure that you don't do those again. See if you can work out what those mistakes have really cost you in terms of R multiple. Because if your goal at the end of the year is to make 15% or 20%, and on each one of your trades you're risking 1%, but you allow trades like the Ramsay one to get away from you and you don't participate in those, then all of a sudden you're going to find that 10 or 15% that you're looking to make are going to be a long, long way away. And as a result, when things seem a long way away, the tendency for people to not stick to their plan increases more and more. So hopefully that sort of makes sense, and it gives you a bit of an idea and a bit of food for thought to think about in terms of what your mistakes actually cost you. I don't think it's something that traders really think about in terms of quantifying what a mistake is. Now, some people are ready to admit that, yes, they've made mistakes, but when you start putting numbers on them, it really does hit home about the cost of those mistakes and the handicap, if you like, or the ball and chain that you're walking around, attached to a leg, if not both legs, or potentially, both legs and both arms. So trading is difficult. Yes, it doesn't have to be. If you keep it simple, commit to following the rules, and be unwavering in it. It does take discipline. It does certainly take patience, and it's something that most traders will have to work on. So hopefully you found that useful, a bit of an insight into quantifying trading mistakes. I think you'll be surprised if you go over and actually do the numbers and add it up. What sort of a handicap have you been to your overall trading success? Guys, have you got any questions for today? It's okay if you haven't. I think it's important to think about your trading in a business type sense. Think about the handicaps that you may inadvertently be dealing yourself along the way. Self-sabotage is a common theme, and certainly a lot of people don't necessarily know that they're doing it. But I think once you make a mistake and you can clearly identify the mistake, articulate it, then I think if you can go through and then work out what it's cost, then you'll understand the need to avoid mistakes and really focus on your trade execution and your trade management. All right, guys, well, that's it for today. I'll go and get this posted. We'll catch up with you on Friday for the macroeconomic analysis session with Jeff. Other than that, if you've got any questions, feel free. Request a coaching call or send us an email or give us a call. Happy to talk through any of the concepts we've covered today. Thanks for listening.